When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Fogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Fogan. And now here's Jeff Fogan and Jeff Shade.
Thank you so much. Welcome to Premier Retirement, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about current events. We'll also answer listener questions and then how to plan for early retirement. My name's Jeff Shade, and as always, I'm just here to ask the questions. But the words of wisdom and solid advice, they come from the other Jeff in this radio program. It is Jeff Fogan, founder and president of Premier Retirement Planning and Wealth Management. Hey, Jeff, how you doing today?
Doing great. It's always good to be here with you and the listeners. Another week. Probably a lot to talk about today.
That's right. Just another fun time talking about what's going on in the market and the economy and what's going on in politics. And I'll second that. It's always glad to be with you, too, and our great listeners here in the greater Tucson area. So let's dive into what's happening right now. A lot of things going on across the country and in the world. Of course, world tensions heating up a little bit. No Kings protests took part all over the country this past week. Do you think that the people who were protesting, and in some cases, I guess, even rioting, I know there were rubber bullets used and so forth, do you think that they really knew what they were protesting, or do you think that they're protesters and rioters who just look for a chance to get out and cause some havoc and loot and break into the stores and steal a TV?
Yeah, I don't know. I think it's weird they call it a No Kings riots and the rallies or whatever they want to call them. You know, I'll tell you what, if there was a king, they wouldn't be out being able to have a First Amendment. They wouldn't have any freedom to loot or to go out and demonstrate and to wreak havoc and to get paid to be a demonstrator and do all those things. I guess they're subpoenaing Soros and some of those other big money guys that are paying for the rioters. It's funny, you can see a lot of times on Instagram and Facebook and stuff, we'll go out and do face searches and you find these same rioters at every stinking demonstration and they've got a different sign up. They're professionals. So, you know, I don't have a lot of respect for those demonstrators. They're just paid to say what they're saying based on somebody else's agenda. I mean, if I thought there was really that many people that believed in what they were holding up signs for and arguing about it, probably listen a little bit more intently, but I'm getting tired of it, frankly. And I'm really happy to see what Florida did. And they said, hey, if you want to be stupid and stand in front of a car and, if you're surrounding a car and they feel intimidated, they have a right to leave the area. And if they run over you, well, that's your fault, not theirs.
Yeah, right.
And guess what? There was no violence. There was no shootings. There was no people run over by cars. And Florida had like the safest No Kings Day parade ever.
Yeah.
Or the No Kings Day riots, because they basically laid down the law and said, this is what's going to happen. These stinking sanctuary cities say, we're going to protect all the rioters and all the stupid people that break things and steal stuff. And the people that have the businesses, own the business and, have a sense of loyalty, patriotism, and pride for their city don't get to say so and don't get to stand up for themselves. And they have to take it on the chin. And I just don't get where that all comes from. This No Kings rally. And then they call it the King's Parade, just because it's kind of ironic that President Trump's birthday falls on Flag Day, which falls on the 250th birthday of the Army and stuff. And they have to twist it so bad and gaslight America to believe that somehow it's him being ego. Yeah, Trump has an ego, but I don't think he threw that parade. I would be really surprised if somehow he came up and said, it just looks bad. Let's just not do the optics. It's my birthday and we're trying to save taxes and just going to cost a lot of money. If he did, and he said, like, where in the heck is his patriotism? It's the 250th anniversary of the Army. He doesn't even respect the people that died and fought for us and gave their life on the line for America and made things great. And he says he wants to make America great again. He doesn't even honor the troops, but he did honor the troops. And I thought what I saw of it looked like it was done well. And they gave a great tribute to those people that have served, that have given their lives, and not just those who died serving, but those who lived serving and gave a big chunk of their life in the service of maintaining our freedoms. The forefathers figured we're great to make them continue to be great. And man, as much as certain parties and politicians and different factions in this country nowadays want to ruin all that, it surprises me when we have so much going for us. And I think that was just a nice display of patriotism and honor. And I thought they did a good job.
Jeff, I want to continue this conversation in just a moment, but I do want to take a very brief moment to remind people of our phone number, 520-780-9059. Listening to the program today, you continue to listen. If our conversation resonates with you, you'd like to get in and sit down and talk with Jeff about your retirement, 520-780-9059 is our number. There's no cost and absolutely no judgment whatsoever. You can make that call right now. Let's continue to talk about current events. Jeff, retail sales slightly softer than we expected. Unemployment is just a very, very short tick up. We're just about halfway through the year right now. July 1st, it'll be about halfway through the year. Do you think that the first half of this year, the first 6 months of Trump's administration, has gone roughly the way that he had intended it? And how do you think that the rest of the year is going to go as far as the market and the economy goes? And furthermore, do you think that we should shy away from the market until things settle down a little bit?
Well, if you look at what's happened since the election, the market hasn't done much. It's pretty much flat, even though it's knocking on the door of the February highs and the December highs. It really hasn't rocked the world like in prior years, this last 6 months or so. But the fact is, there's a lot of things that have rocked the market. The Tariff Freedom Day or Liberation Day or whatever it was in April, it had a big sell-off and had everybody running for cover. It didn't really last that much. They turned that market around a little bit. I mean, quickly, and it looks like it's plugging away. I know that anybody in the White House doesn't want the market to crash on their watch, and they do a lot of things that, even manipulate the market. Like they'll get together with the Fed and banks and everybody and start buying futures to make it look like the market's going up in the future, even though there's really no underlining reasons for it. Fundamentally, there are some technical reasons for it. If you just look at technicals like charts and things like that that have to do with trends, you can kind of follow the money there and see that we're really in a top-heavy position market-wise. However, what I am really happy about and what gives me a lot more confidence in being in the market right now, even though I do think we're due for a correction, it's overvalued. Everybody says it's overvalued. You still have people like Warren Buffett net selling on a monthly basis and selling more than he's buying. He's the GOAT. I mean, he's the best ever as far as investing long-term and understanding the markets and understanding cycles. And he's been right more than he's been wrong. He's been right probably more than anybody. Ray Dalio, he thinks there's a big credit crisis coming and a big correction. They've raised a lot of cash, the biggest hedge fund on the planet, Bridgewater. A lot of smart money is running for cover all the while. The news and all the cheerleading from Wall Street is buy, look, buy the dip. I don't think that April was really a dip. It was kind of a sign of things that should be coming based on fundamentals, based on the overvaluation of the market. And even though we've seen unemployment kind of hold steady, it ticked up a teeny bit. What I am encouraged about is that the tariffs have not created huge increases in prices, at least not at this point. Some people might say, well, that's because companies hoarded all the imports before it all happened and they're selling those right now. And so they're able to keep the prices down. But there's a lot of companies that are raising prices because of tariffs and imports that haven't even been hit with the tariffs. They're just doing it because they can get away with it. Even with that, you look at the inflation numbers, they're about as low as they've been in a few years. The tariffs and the big scare of everything's going to cost too much and people are going to be priced out of life and aren't going to be able to afford just the basic bare necessities. I mean, we've seen things like eggs come down, gas come down, transportation come down, food comes down across the board. Job wages haven't been hit. You've got people who get Social Security and tips are going to be able to keep a little bit more of that money. Yeah, it's not all tax-free. It's not all pure free money like Trump was touting and hoped to get when he ran for office and campaign on. But once you run those big bills through Congress and the hundreds of people that have to see him and want their little 2 cents to be put in there. And then there's also those people that want to be a little bit more cautious, that don't know economic math like Trump does and just says, oh, well, we can't cut taxes because we will never be able to pay our bills and we can't increase the budgets and pay all of our cronies all what we've promised them unless with all these tax cuts. Well, there has to be some sort of a happy medium. And there is. I think there's been some good compromises in that bill where we're still going to get some tax decreases and tax breaks. Whereas we can't get too excited about the fact that the economy really isn't robust. What I am encouraged about, and I said this last week on the radio show as well, is I'm encouraged that we're building a foundation where companies do have the potential to earn and to grow their earnings in a way, especially because they're being protected with tariffs and things like that and foreign competition. Especially the American-based businesses have the ability to be more profitable, have better earnings, and possibly support or justify some of the price earnings ratios and some of the fundamental numbers that we're seeing in the stock market that appears overvalued, and it is overvalued. Either the earnings have to come up as they've been promised to over the last few years, and they haven't, or we've got to have a market correction and have the prices come down to where it's rational and realistic again. It's like going out and shopping for cars right now, and Toyota Camry is $100,000. Well, the prices are probably going to go down to $40,000 again. Do you really want to buy it at $100,000? just because everybody's willing to, or do you want to wait till the price is more sane? And I think that's the way we have to look at the stock market, even though there are some stocks that I think are fairly valued right now that have robust earnings and good growth, not only potential and prospects, but they're actually doing it right now. They're creating a lot of growth within their own industry, within their own market sectors, and their own companies are being run very well. So if you're a good, picky investor, you can find those golden opportunities. But if you're just doing the indexes and just seeing the market overall, I think we need to be a little bit cautious, especially if you can't afford to lose the money. I have no problem with somebody in their 40s or 50s that is putting $400 a month away in their 401k or $8,000 a year into an IRA just to be consistent and save. Put it all in risk. It doesn't matter. But if you're retired or nearing retirement and you have $1 million that you need to live on and has to carry you for the next 30 years, you probably don't want it all in the market when the market's valued this high. That's really the focus here. It's not that I think the market's a bad place to be. I don't think the market's a bad investment. I think long-term, it's a great investment. I just think you have to realize what that money is used for. And the stock market money is used for long-term growth, and it's used for the set it and forget it and not to get too excited about it if you're not using it on a day-to-day basis to live. But if you are, then you have to take a different approach. And that's why I like principal protected products that are indexed so that if the market continues to defy gravity and surprise us, we still make money. If it doesn't and it goes down, like I think it's kind of due for, and as in Warren Buffett, we talked about the Warren Buffett indicator, way overvalued territory. It's only been this bad a couple of times, like in the dot-com bubble that burst and became the dot-bomb bubble. And even the banking crisis in 2008, the market valuations weren't as absurd as they are right now. So we've got to look at that, be realistic about it. We've got the Shiller ratio, the Cape-Shiller ratio, which talks about the adjusted price earnings ratios, cyclical price earnings ratio adjustments. And that is a cycle that can predict the next 10 years in the stock market. If you look at where the average price earnings ratio is, in other words, how much we're willing to pay on a stock for $1 worth of earnings, you're looking at the next 10 years in the stock market averaging -2 to maybe +2. So in other words, we're on the verge of a lost decade if history repeats. This is a historical cycle and a theory that's been proven over and over again, 7 or 8 market cycles over the next 7 or 8 decades. So it's not like a new theory that might work. It's something that has been counted on before and probably can be counted on going forward. So we have to be cautious. We have to realize what bucket is that money for? Is that bucket for long-term growth, or is that bucket of money the stuff I'm going to live on? And if it is, we need to invest appropriate. So again, you asked me if the market was a good place to invest right now or if we should be cautious. Yeah, I think we should be cautious if it's money you're going to need to use on a regular basis anytime soon, or if you're already in that mode. And if you're not, put as much money in there that won't make you sick if it goes down 20 or 30 or 40 or 50%, because that's what markets can do. In a bad month, shoot, the market went down 20% in April and got most of that back in the last 2.5 months. But we can see some frustrating times and some gut-wrenching market cycles if you are dialed in and looking at it every day. So again, we don't want you to put what I call scared money in the market. We want you to put smart money or long-term money in the market, and your smart money is the money that you need for income, needs to be principal protected, and the kind of money that you invest for that purpose.
We're talking with Jeff Hogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. We're also talking about current events. Our phone number, 520-780-9059. If you'd like to have a casual conversation with Jeff to talk about your investments and how world politics and economic news may impact those investments, no cost, no obligation, 520-780-9059. You can make that call right now. Jeff, about a week ago or 2 weeks ago, we mentioned the fact that safe investments, particularly annuities, have seen a great rise in the last year or so, I think record numbers. And that indicates that some people may not have a lot of confidence in the stock market. For those people who maybe do not want to be in the stock market, what sort of other investments might they look at that are non-market related but might have a chance to give the same sort of returns?
Well, if you want the same sort of returns that the market can give you on the upside, there's not really a cake and eat it too, where you get 100% of the upside and none of the downside, but you can get some of the upside and none of the downside. And if we look at what I was just mentioning in the last question was, what about the market and what about long-term investing and what's the market done so far? And it's pretty flat from the beginning of the year till now. Is there something else that would have been better? Well, yeah, if you look back, a CD would have been better, right? Or high yield savings would have been better. If you look back a year or so and realize that the market's up 6 or 8% from a year ago, what can you do that's better than that? There are principal protected annuities that are up 5 to 7 or 8% that are pretty close to what a stock and bond portfolio would be worth. Oh, and by the way, if you had stocks and bonds, you're probably break even or low since a year ago because the bond market's been trashed. I think people are a little bit worried about the ability for America to pay its debt as we increase our debt so fast. I mean, it's compounding at an outrageous rate. And we have to be conscious of that. The rest of the world is going to be a little bit nervous about buying our bonds unless they pay a little bit better interest. So interest rates have been going up, bond prices have been going down. And so if you're in the bond market, you've probably not been very happy. If you're in the stock market, you've been on a roller coaster ride and it's a gut ache. So if you want to get rid of that gut ache and still have upside, you have to really back test and look at historicals in order to guess the future, because you can't guarantee the future on what's happened in the past. You can only use it to be information that helps you decide if you feel comfortable about the type of investment you're making. But some of these indexed annuities that I've talked about, and even LIRPs, life insurance programs that are insured products, where the insurance company doesn't risk the principal. What they do is they invest and they use options on the interest that they make on your money, and they put it in indexes and they bet on the indexes, and they can turn something that might have a yield of 4 or 5% a year into 10 or 15% a year if those things that they buy options on. In other words, they roll the dice on that money out there and they try to bet on the upside of certain indexes. And they have these dynamic indexed algorithms that change from one sector of the market to another sector. And the cool thing is they've been built on a lot of data from past decades, and they can build these models. And so far, going forward, as they've come out in the last few years, these indexes of indexes, and they're called hybrid indexes, I guess you want to call them for lack of a better word, they actually rotate from the market to other markets and other indexes that may be performing better at any given time. When the market goes down, they don't lose money. And the only thing that they are at risk is the interest that you make on your money. So in other words, your principal is protected. Those assets are invaluable. They are gaining so much steam. So many more people are buying them because they're finding out about them through radio shows like this, through the TV programs that we have, seminars and classes. There's just a lot of ways. And friends and neighbors are starting to talk about them, where people are saying, man, I sure took a beating in the stock market this month. And, out in the golf course, your friends are, well, I'm up 10% from last year and I didn't lose anything. Really? How did you do that? Well, I've got principal protection. Every year it locks in, or every so often my basis changes to whatever the value is on that date. In other words, you get this stepped up basis on a principal every so often, typically a year. Some do 2 years. We even have some laddered products where some of your investment locks in on a yearly basis. Some locks in a 2-year, 3-year, 4-year, and a 5-year basis. Each segment that's longer, you get a higher piece of the gains that you make. So when you look at some of these products and you backtest them over the last 5 years, you can see that some of them will actually keep up or even beat the stock market if we have volatility like we've seen lately and like we may see going forward. So again, that's the kind of money that I'd prefer to use for income, because you're not dipping into principal with market corrections. You're only dipping into principal if you actually spend the money. That's the only way I would like to use principal. You've saved that principal, use it. If you can make interest on that principal and use only the interest, even better. Most people save money because they intend to spend it, maybe some of that money plus the interest over the course of their retirement life. So again, there's 2 buckets of money, the kind that you risk and you don't touch for income, and the kind that you don't risk and you can use for income. That's really the 2 main buckets. Now, obviously, there's more buckets. There's a short-term bucket, mid-term bucket, long-term bucket, growth bucket, legacy bucket. You can name all kinds of buckets if we want to talk about buckets of money or styles of money. But there's really just 2 types, the kind that has growth and risk that you don't want to rely on for income, and the type that doesn't have growth and risk that gives you the peace of mind and the confidence in retirement to not lose sleep at night and to live a nice, long, healthy life and retire on your terms, not the market's terms.
520-780-9059 is our telephone number. We're talking with Jeff Bogan of Premier Retirement Planning. We're talking about the market, the economy, and I want to shift this conversation, Jeff, a little bit to artificial intelligence. We really can't do a radio show these days without talking about AI. Jeff, AI is going to be the most significant driver of the increase in energy, with electricity demand from AI-optimized data centers projected to more than quadruple by 2030. With this energy consumption that is projected to increase by that much, should energy be a sector that we should be looking at as far as commodity investing goes?
Well, I think it should be. And, it depends on type of energy. Some ETFs, when you buy exchange-traded funds that are skewed towards energy, some are skewed more to nuclear, some are skewed more to the oil industry, some are electric power generators, solar, and so forth. So you can get some that are really encompassing and that cover a huge amount of energy allocations. I'm a little more specific. I really like how the clean fuel and the energy market, especially that they're expecting to use for the AI side of things, is the nuclear business. I mean, they're building mini nuclear plants. You got General Electric getting into that business, even Rolls-Royce is. You've got all kinds of different companies, some you never even heard of, that are growing like crazy and doing a really good job. And you look at their stocks and they're up 100% or better in the last year and probably going to continue to do that. I don't know that oil stocks are going to do that kind of a rate of return. So that's what I mean. You might want to be picky about the type of energy that you go into. I mean, if you look at oil as an energy source, the fact that we've got World War III possibly brewing over in the Middle East might put pressure on oil. However, if we're going to drill, baby, drill in America and keep the prices down, we might offset the fear mongering that typically drives the oil prices worldwide. If America becomes energy independent again, which we were last time Trump was in office, we're actually smooth sailing with the standpoint of energy. The energy costs are down, which means profits may or may not be up. Typically, profits are up when you have to overpay for oil and the companies get a chance to exploit that and charge too much for the product. But if they're the producers and they can produce cheaper, they can still make profit, decent profit, probably not the kind of growth we're seeing in the AI/world of nuclear power, but definitely all those things that use energy are probably going to be the better sectors. Maybe trucking companies that don't have to pay so much for gas are going to actually be the better buy based on that type of an energy, just a change in the lower cost of energy and the abundance of energy from the oil and gas side. So again, I think energy is a big deal. You've got companies, again, we've got the solar industry that even though it's clean energy and even though the Trump tax cuts kind of blew it out of the water from the standpoint that they're not going to subsidize people's solar panels anymore, but they are going to put tariffs on the solar panels we import from other countries, especially China. And so companies like First Solar and others that build those products here in the U.S. are going to benefit by that. So I think there's probably some upside in the solar business. I think with the tax hiccup that they had through the new tax bill, solar power is probably going to get those stocks beat up pretty bad, but they're profitable companies. So I think there's some opportunities there. Again, there's plenty of opportunities in the energy business. I think we have to look at all the different ways that energy can grow. There are companies that basically just buy energy off the power grid, no matter where it's manufactured, and they basically resell it, or they'll set you up with we've got some stocks in our portfolio that are thriving up 50, 60% just year to date, that go into homes, and what they do is say, hey, we'll manage your electricity and we'll use the time of use program and automatically program it where you only get this much power for this time, and we'll sell it to you cheaper, because when they buy in bulk, they can get it cheaper. So they can not only save the consumer money, but they can make a profit doing it. So there's a lot of win-win in the energy business, whether it's electricity, whether it's from solar, whether it's from nuclear, whether it's from oil and gas, diesel, whatever it is. I think we're just going to become more and more dependent on energy. So yes, my answer is yes, that sector is definitely one we want to focus on, definitely one that I think is probably more recession-proof than many. The durable goods possibly are a lot more hit with, and also the consumer discretionary type things are probably the ones that are most likely going to be hit hardest if we go into a recession. But everybody needs food, everybody needs energy, and with technologies and the advancements we're doing there and the energy that we're going to need, I think creates a good opportunity going forward.
Well, Amazon is offering something like $334 million for a nuclear reactor, a small nuclear reactor to be built in Washington. And I remember when Amazon just sold books, and look how far they've come, so they must know what they're doing. Talking with Jeff Hogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. Our show, of course, is called Premier Retirement. If you would like to set up a casual conversation with Jeff to talk about your portfolio, your retirement portfolio, your investment portfolio, or your wealth management, certainly we are offering that at no cost and no obligation today for our loyal listeners. 520-780-9059 is our number, 520-780-9059. You can make that call right now. Leave your name, telephone number, and Shelley will call you back during the week to set up that appointment. Once again, no cost and absolutely no obligation. 520-780-9059. You can find out more about us online at premret.com. Jeff, time for a break. When we come back here on Premier Retirement, we've got listener questions and more when our show continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Hogan and Jeff Shea.
Happy first day of summer. We so much appreciate you making us part of your plans here for the first day of summer and all year long, each and every Saturday, Sunday for Premier Retirement with Jeff Hogan. We're on the air for you both days, of course, Saturday, 7 a.m., 9 a.m., and 1 p.m., and Sundays at 11 a.m. And as always, we're available to you on your schedule via our podcast. Go to wherever you get your podcast, search for Premier Retirement. You're going to be finding this show and all of our past shows so you can stay on top of your journey towards a confident retirement. 520-780-9059 is our telephone number, Jeff. People want to talk to us. Also use that number to set up your confidential No cost, no obligation, complimentary retirement planning session with Jeff. We call it the Retirement Roadmap. Again, 520-780-9059. All right, Jeff, let's dive into listener questions. Vaughn's listening to us in Tucson today. Vaughn says, my mother-in-law is 95, and she has $400,000 in stocks. Would it be smarter, tax-wise, to gift it to her 2 kids, one of which is my wife, or leave it to them in her will? What do you think?
Well, I don't like either idea, but let's talk about the tax situation on that. There's no benefit to gifting those stocks other than the fact that if she would gift them, you don't get the step up in basis you get if she dies. Doesn't your mother-in-law maybe need that money? If she's 95, she goes to a nursing home or, heaven forbid, an Alzheimer's facility at $10,000 a month for the next year and a half or 2 years, she could need to spend that. And if she spends it and she has to take a capital gains tax on that, but she gets to write it off against nursing home bills, et cetera, I think that would be a smarter way to go. If she gifted to you and then you ended up having to sell the stocks and you made some money, you have to pay taxes, and she didn't have the money and you wanted to pay for her long-term care, whatever final expenses she might have, you don't get the write-off as she would. But I just don't see the upside to doing anything with those stocks until she passes away. If she's 95, it doesn't look like it's too much longer. And I don't know if that's all the money she has or if she has other money as well. There's probably a lot more to this story than I'm seeing. But right now, just from that one answer and that one scenario, I'd say, let her keep the stocks. If they've been doing well, I would assume if she has 400,000 stocks and she's 95, she's probably got some buy and hold stuff. She probably bought Apple in the 80s or something like that, where she's, maybe she's only invested $30,000 and now it's worth 400 grand. She might have huge capital gain situations, so she might not want to take those losses. There is another school of thought, though, if she wants to preserve those assets, and maybe she has been trading or she's had some money manager managing those stocks, and every once in a while they trade, rotate in, dollar cost average. Maybe her basis is $380,000, and if she sold them, she'll have to pay $20,000 in taxes. If that is all of her money, you might want to think, okay, if she should need this for those final expenses and she doesn't want to lose money and the market appears to be overvalued by any, not even by any stretch of the imagination, but by any smart investors, it might be not just tax-wise, but money-wise to take profits and just ride this thing out at 5% a year till she passes, then pass on the money to you. I don't see any benefit in her gifting it to the kids unless she just wants to watch her kids and grandkids spend it now while she's still alive. Maybe she has tons of equity in her house. Maybe she has tons of other assets. Maybe she has $1 million in CDs in the bank that she can use for her personal expenses and just wants to give those stocks away. But honestly, if there's any appreciation in them, it's better just let them step up in basis on death. The step up in basis has been around for a long time, especially with people that have owned stocks for decades. And that is because it's hard to go back and find out what the cost basis is anyway. And I just don't think that they're going to change that tax law and not use a step up in basis on death. So, yeah. And by the way, I would not use a will. I would have her put a POD, which is called pay on death, or ITF, which is called in trust for, and put those stocks in an account that has a designation that will pay directly to your wife and her siblings, those people that are going to be her 2 heirs. If she just put both those names on that account, it would go direct to those people without probate. If you use a will is a probate document. You don't want a will, as much as it seems like the old cliche way to retire and the way to pass on your estate. A will is a trouble document. It's basically the ways that the lawyers get their fingers in on your estate and take a piece of your inheritance just for being a lawyer. And they don't have a right to it. It's kind of like an entitlement program. A will is an entitlement program for the law profession I don't want to be so crass as to say to steal your money when you die, but guess what? There's a lot of cheaper ways to pass your money on to your heirs without having to do the probate thing. And a will is a court document. And typically, if you go to court, you have to have an attorney, and it's typically costly, time consuming, and a pain in the butt. So avoid the pain in the rear, get the step up in basis, have your mother-in-law just keep those stocks. If there's a reason to sell them and take profits because you made a ton of money, it might not even be a bad idea to pay taxes on some of that stuff. If you think certain stocks are maybe way overvalued, gone way past their true market prices, maybe take profits. You never get hurt taking profits. You got to kind of weigh all those things. If you want a second opinion where somebody should look at it, maybe you come into an advisor like us or somebody else that manages portfolios, then give you kind of an assessment on what stocks you might want to hold, what stocks you might want to keep. There might be some losing positions in that would offset some of the gains, where you can take some profits and take a loss and offset the tax ramifications of that. And then she could raise a little bit more cash where she could spend that on some of those final expenses or just the living expenses that she might have in the next 5 or 10 years, depending on how many she ends up making. So again, that's my 2 cents. I hope that helps. And if you need a second opinion, we'll be happy to see you.
All right, Vaughn, thanks for listening to us in Tucson. And remember that phone number, 520-780-9059. If you'd like to talk to Jeff, it's 520-780-9059. I have a feeling there might be a few details in there we'd like to know about. Next question, Jeff, is one of those, again, we're going to get out our scorecard here to keep track. Ken's in Marana. Ken writes, I'm 57. I have $1.1 million in my 401k and $50,000 in a high-yield savings account. I have a $220,000 mortgage on a home valued at $550,000. I would like to retire at 62 with no debt. So what does he owe? Something like $330,000. My wife and I will collect $3,500 each month in Social Security, and if I withdraw $5,000 per month from my 401ks, I'll have a projected positive cash flow of $1,800 each month. Is this a good plan? What could I do to make it better besides delaying retirement?
Well, I could start at the end and go backwards or just start at the beginning. Let me just start at the beginning. So you're 57, you're going to retire in 5 years. I don't know how much money you make. You have 1.1 in your 401k. That's great. Are you still contributing to it? Maybe you're contributing $30,000 a year to that. $50,000 in high yield savings account. That's great. Let's just say that's part of your emergency fund. You can always use some of the 401k money as an emergency fund. You can take loans from it in most cases if you ever had a bigger emergency than $50,000. You have a $220,000 mortgage. Now, there is smart reasons to pay that off. One might just because it makes your gut feel better because you have a mortgage-free house. My opinion is mortgages are a good thing. Honestly, the more equity you have in a house, the more somebody can sue you out of it. There's only a homestead exemption that only covers a small fraction of that. And typically a mortgage is actually a barrier to lawsuits and losing that. The other thing is if you have a $220,000 mortgage that's paying 3%, and your high yield savings account that you're getting with that $50,000, I would imagine if it's a high yield savings account, you're probably making more than that, more than 3, probably making closer to 4. So keep making that money. It's called arbitrage. If you can make more money on your money than paying it off, that's a good thing. I would never suggest you yank money out of that 401k and pay off that mortgage because you're going to have to pay taxes on it. In other words, if you want to pay a $220,000 mortgage off, you're going to have to take out approximately $300,000 out of your 401k in order to pay that $220,000 mortgage. About $80,000 or more is going to be in taxes. And that would also force your other money into a higher tax bracket than you're probably at right now. If you wanted to pay down your mortgage in the next 5 years, may I suggest putting about $45,000 a year of what you earn. If you're earning $200,000 a year and after taxes, you're taking home $150,000, but because you're putting $30,000 into your 401k, you're down to $120,000, it's kind of getting a little tight. Well, maybe you just don't contribute to that 401k, or you just contribute as much as the match that your employer gives you. Keep $20,000 or $30,000, tighten the belt buckle a little bit, and try to pay that mortgage off while you work with working cash flow rather than $1.1 million. Another thing you can do, not maybe right now, but soon in your 401k when you're 59 and a half, you can move some of that off the table and lock up an income stream that would be easily far more than that $5,000 per month from your 401k. In fact, if you put about, so let's say $700,000 or $800,000 of that $1 million of that 401k, let's say in a couple of years it's worth, let's just say it's flat and it's maybe up a little bit and it's worth $1.2 million when you're 59 and a half. Most 401ks, almost all of them that I meet, unless it's from a very small, tightly held, small company, private business, you can take that as much as you want out of your 401k and do an IRA. I like income annuities, investments that have principal protection and guarantee income for retirement. The projection of that $50,000 is probably based on the 4% rule that Fidelity or Merrill Lynch or whoever you have your money with tells you is a good rule of thumb number to pull out. Well, if the stock market averages 10% and the bond market averages 5% over the last 100 years, why are we only taking $50,000 out of a $1.2, $1.3 million investment? Well, that's because of volatility. What if you could put, let's say, $700,000 of that money into an account right now or in 2 years and defer it for 3 years and have a payout of $75,000 a year instead of $50,000 a year and still have $500,000 to invest any way you want to and play the stock market, day trade, do whatever you want, not worry about losing any money. You have more guaranteed lifetime income that way on less money than you would just using the 4% rule, keeping your money in the stock market. Oh, and by the way, that extra money would be far and away more than your mortgage payment would be, in my opinion. So your cash flow, you said even with your cash flow, you have $1,800 each month in net positive cash flow. Well, what if you upped it by another $2,000 a month? There's $3,800 each month. I'm guessing that your mortgage is far less than that. So again, if you want a comprehensive plan and you want some really, really good light at the end of the tunnel for retirement for you, you can live on a lot more than the Wall Street model says you can, just by using investments and accounts that were built for retirement, that were built to be personal pensions, just like people that have a pension. They don't have $1 million 401k, but they've got a $50,000 or $60,000 a year pension. That's the same as having $1 million 401k in the market. But if you have $1 million 401k, you can make it like a $2 million 401k if you compare it to what a typical pension would pay, just by strategizing and diversifying into the different types of income producing assets that there are. Especially right now when the interest rates are higher than they've been in so many years, I'm seeing the guaranteed income that insurance companies are willing to give you on your money to pay out as a lifetime payment benefit are higher than I've seen in probably close to 20 years. And that's because interest rates are high. The investment opportunities are better. Algorithms are a lot better at predicting income market changes and doing things with investment money that we weren't able to do 20, 30, 40, or 50 years ago. So you're retiring at a great time. There's so many baby boomers that are retiring that, the industry has really stepped up to make products that work wonders for people that want to retire on their terms, don't want to run out of money, want to have more money than they thought they could have on the typical retirement plan, and have a lot more peace of mind, a lot more confidence, and be able to have a lot more fun.
Ken, that's a great question. Thanks for listening to us in Marana, and we'll send you out Jeff's book, Retirement, The Road Ahead. Again, if you'd like to talk to Jeff in person, 520-780-9059 is our telephone number. Next question, Jeff, is from Tricia, one of our younger listeners. Tricia's listening to us in Dove Mountain. And Tricia says, my husband is just about to receive just short of $1 million from his father's estate when he turns 30, which, by the way, is in about a month. Now, my husband makes $70,000 a year as a police officer, and I'm a stay-at-home mom with 2 small kids. We have $15,000 in credit card debt, a car loan at 8% with $30,000 left. We owe $280,000 on a house valued at $350,000, and the mortgage is at 6.5%. So she didn't get in on the 3%. They bought it after that. We'd like to upgrade to a $450,000 to $500,000 house. My question is, should we pay off all of our debt or some of it, and how should we invest the rest to provide income while protecting principal and pay for our kids' education and maybe even save for retirement? A lot of goals she's got there.
Oh, man, there's one bucket that would cover a lot of, that would be like how you kill 2 birds with one stone. You can kill like 3 or 4 with one stone. I'm going to talk to you about LURPs, okay?
All right.
Now, I have no problem with you wanting to pay off your debt. Definitely the credit card debt that's got to go. Yeah. 8% on a car loan. Heck yeah, just pay that thing off. $70,000 a year. You're a stay-at-home mom with 2 small kids. That was our family. We had 5 kids and a stay-at-home mom. So I know how hard that is to working your rear off and choosing sometime between diapers and food some months. So the less debt, the less cash flow problems you have, probably the more peace of mind you'll have. But here's the deal. With $1 million, you're in your 30s, just kind of starting out. You're just getting going. I don't know that maybe getting that bigger house is quite the best thing to do. I do think interest rates are going to go down and maybe you finance it, but prices of homes are going down a little bit. I think just mostly because interest rates are high and people are having trouble financing. That 6.5% mortgage is high enough that I'd say, man, I'd love for you to try to get rid of that. If you did, and let's say you have still $600,000 left after that inheritance, and if you put, let's say, half of that in the stock market, and over the next maybe 10 years, you put the other half into what's called a LURP, a life insurance retirement plan. Not only would you have more than $1 million in death benefit should your husband somehow meet his maker earlier than planned or whatever, would leave you a nice death benefit for one. The other thing is you can borrow against that death benefit and you can get about 3 times your money. So let's say you put $300,000 into it over the next few years, you get at least $1 million in benefit, and you can borrow against that at any time without raising your tax bracket. The cool thing is when you have your kids that are ready to go to college in 10 or 15 years or whenever that happens, you might have $400,000 or $500,000 in cash value in this LURP, which is a kind of a stealth retirement plan. You don't have to wait till you're 59 and a half or 50 to take money out. You don't have to take a loan against your 401k. Now, I'm sure as a police officer, he's got a 457B or some sort of a deferred comp plan at work, probably through Nationwide if he's here in town, and you can pay into that and defer some of that comp if you're making ends meet. Now, I would imagine with the bills on the credit cards, the car payment, the house payment, and everything else, I'm guessing that there's really not a lot of room to put into that type of a deferred comp plan. I would try to be able to do that if you can get some of these monthly bills down and you can invest in some things that would generate enough income that you could cover that cash flow and cover other expenses, like with a non-taxable private bank retirement account. And that's kind of how I'm going to describe what I believe how a LURP works, life insurance retirement plan. Permanent life insurance can be invaluable to not just legacy planning or not just income replacement planning or just, what if something bad happens planning. It can also be used to borrow against that death benefit to send your kids to college. And the cool thing is let's say by that time your husband's making $130,000 a year, you're just knocking at the door of that 25% tax bracket. And you know that if you take money out of investments or make interest or cash something out that has a tax ramification, you're in a 25% tax bracket. What if you could pull $100,000 out to send your kid to a great college and it not actually cost you a tax burden? But if you take that loan to put in your bank and then you write a check for tuition to the institution, to the bookstore, those things that can be basically a write-off because it's a direct contribution for education, you actually get some tax benefits for that. And it doesn't cost you any taxes to take the money out. So you could get actually a double tax benefit by planning for college educations this way. And I would say, just based on my thoughts, there'd probably be somewhere between $60,000 and $100,000 in cash flow that you could get from that retirement plan in the mid 60s, if that's how long your husband decides to work. $60,000 to $70,000 tax-free cash flow, plus whatever the pension is, maybe another $50,000 or so, plus Social Security, another $40,000 or $50,000 or so. You could be living on $150,000 to $200,000, which might not be quite the same as that is today, but in retirement with no bills, that's like living on $120,000 today, perhaps. So again, look at those options. If you want to crunch some numbers or get some options laid out, I'd love to see more of the story, or when that $1 million comes, you want a second opinion, we'd be happy to talk to you, look at it, and show you more details of what I'm talking about. But there's a lot of people that inherit. You don't have to be 30 to do this. If you're 30, you just have a lot more benefit from it, because interest on that money compounds tax-free for decades. But if you're in your 60s and you're inheriting money, or if you're in your 70s and inheriting money, not quite if you're in your 80s, but if you're in your 60s and 70s and you're healthy, you can actually use life insurance to protect that asset from taxes, principal protect it, and use it to your advantage to get more cash flow than you could from a Roth IRA or from some of the annuities that are out there, or even some of the 4% rule of thumb withdrawal rates from the typical stock and bond portfolio. So again, you have to look at all the different tools that are out there. You don't build a house with just a hammer. You have all kinds of other things that you need. We have all the tools. As a comprehensive planner, we try to use all the tools for what's best at any given time. But again, you're not going to find out about what I'm talking about at your 401k or your employer, most likely. That's a significant amount of money and can make a huge amount of difference in the future if you don't blow it, if you don't make mistakes, and if you know what your options are before you take that first step forward.
Congratulations, Tricia. That is quite a blessing, and I would advise you to come in and sit down with Jeff and really have that conversation about what you should do with this money and in what order. 520-780-9059. Make it a blessing, not a burden. 520-780-9059. We appreciate you listening to us. We'll also send you out Jeff's book, Retirement, The Road Ahead. Listening to Premier Retirement with Jeff Vogan. Again, that's our telephone number if you would like to have a casual conversation with Jeff. No cost and no obligation. 520-780-9059. Jeff, in our next segment here, want to talk about retiring early. And in this case, we're going to, in our example, say that the person wants to retire at 62. That person is now 58 years of age. So they have a crucial, critical 4 years before retirement. Now, being that they're retiring at 62, that's a little early for Medicare, and they can get Social Security. But what do you think are some of the key elements that if someone's wanting to retire early before 65, that they should consider doing?
Well, when it comes to Social Security and even planning in general, you can maximize Social Security. Everybody says, well, how do I maximize? I want to get the best bang for my buck. Well, the way to maximize your Social Security paycheck is to take it at age 70, live a long time, and hope they don't change the rules. Okay, that's the best way. That doesn't always optimize your retirement, however. So I believe in optimizing retirement. It may be smart for you to take Social Security early and not spend money that could grow for income at a guaranteed 9%. For example, as long as you wait on Social Security, you get about a 6 to 7% rate of increase plus a cost of living adjustment for every year that you wait to take Social Security. So let's just say at age 62, it'd be $2,000 a month. But if you waited to age 67, it would be closer to $3,000 a month. Well, you also gave up about $150,000 worth of income by waiting to take it. What if that $150,000 could pay the bills and you left that $150,000 sitting in an annuity that gave you a 20 or 30% income bonus right up front and grew at 9.5% for the next 5 years? You're looking at about a $300,000 benefit, which would guarantee about a $1,500 to $2,000 a month bump in income instead of $1,000 more a month just by waiting on Social Security. So again, there's different ways to invest your money. So if you could invest some of your IRA money and defer that so that you get a higher guaranteed income, that's even better. Here's the thing I don't like about Social Security. The longer you wait, the longer it's going to take for you to get back what's yours. In other words, what you've put into it, what your employers put into it over the years. What if you get hit by a bus when you're 70 and you didn't start Social Security until you're 67? Well, that's a bummer. You only got 3 years of payments. Well, if you have a spouse, that might not be a bad idea because the spouse who might have been getting less money than you on Social Security now gets to take your higher amount. But is it that much higher? But what if you both pass away? Then you never got that money out. If you put your assets that you could defer for income, that again, grow faster for income than Social Security grows, and you get your money back, why spend that money now? Spend your Social Security money now, get all you can out of it. And if you can't spend all of it by taking it early, if you're going to retire early, then reinvest it, let it grow someplace. And that's essentially what we're talking about. spend down the money that you can't grab the pile of leftovers from if something happens to you. But if you put something into an index annuity with an income rider, I've talked about those a few times now on the show today, and in various shows, I talk about them on a regular basis because it's kind of the core plan is Social Security, complement it with income from an annuity that's guaranteed for life, regardless of how the annuity performs. Now, most of these companies know how the annuities are going to perform because they're pretty smart and they're going to make it work. But if they don't, they're going to take the risk on themselves. They don't let you with the risk. With the stock market, if the stock market doesn't play out, it's like, oh, well, man, the market's tough. Sorry. Go get a job when you're in your 70s, or ask your kids to move into their house, or ask them for money. Well, no, retire and guarantee it. Insurance companies are smart. They have reserves. They have guarantees that they can put on the back end of their investments to make sure that they don't lose your money. And you might as well take advantage of it. So again, you can strategize between Social Security. I'm more in the camp of taking Social Security early and deferring your investments, because the deferred investments now can grow on a very significant upside basis. Whereas if you look at what they used to pay at 1 or 2 interest rate percentage, it's kind of sometimes better to just wait on the Social Security. But again, it kind of depends on what times we're in, how much interest rate the other investments are paying, how much you can make, how much you can guarantee, and if that investment plan is still available. The cool thing about deferring an annuity with income is, let's just say you both do get hit by a train. Yeah, I hate to be so callous about it or so cavalier about talking about somebody's demise, but we might get hit by the bus going to heaven, a little early. So what if we both take that bus home a little early, and we're on Social Security and we spent all of our IRA money and other money down so that we can get the biggest paycheck possible, and then we end up not getting any Social Security back? They're not going to give the rest of your trust fund to your heirs. They're not going to give that to your kids or anybody. But what about the $1 million you had in your 401k that you only had to spend $300,000 of to get you from age 62 to 70? You took a few payments from your Social Security, but now there's still $700,000 of your $1 million left, rather than having to spend $100,000 a year out of your 401k, have nothing left when you're 70, and then end up not getting any of your Social Security back. So again, I believe in looking at all the pillars of planning, not just your own investments, your income plan, your tax plan, because that's going to also have a factor on how long your money's going to last. Your long-term care plan, is some of it going to be set aside or earmarked in case you have to go to a long-term care facility, or you have somebody come take care of you at your house? Or what is your backup plan for that if you don't have a long-term care insurance policy? And by the way, I don't advocate very often for a long-term care policy, the pay-as-you-go kind. They raise your rates, and typically you can't even afford them by the time you need them, and they like to deny claims. I like doing it on your own terms. Maybe use your home equity as your long-term care backup plan. You can even reverse mortgage it if you needed to for that. Or you use LERPs and other annuity type products that guarantee you have your money, but they will enhance the returns and give you extra money should something happen to you that requires a long-term care stay. So again, after that, then there's the legacy plan. Do you want to maximize what you can leave those people you love as well? Well, why not? Don't leave it in the trust fund, the Social Security. Those aren't usually people you love. It goes to somebody, but you probably don't even know those people that it's going to end up taking that money. I believe in retiring on your terms means keeping control of more of your assets, and honestly, not worrying about what Social Security pay. Worry more about keeping what's yours, and making the best of Social Security and kind of fitting everything around that.
Jeff, running a little short of time this week, I do want to remind our listeners before we go today that if you're thinking about retiring early, you're not sure whether you can do that, call us here at Premier Retirement. Sit down with Jeff and he'll run the numbers. 520-780-9059. No cost, no obligation for this. We call it the Retirement Roadmap. 520-780-9059 or online at primret.com. As I said, Jeff, out of time for this week. I want to thank you for your time, but most of all, thank our great listeners for joining us. For Jeff Hogan, I'm Jeff Shade. Have a great weekend. We'll talk to you again next week right here with another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage, Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy, and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.